Very good afternoon, everyone. Thank you for joining on this call. After a one-way rally in the last 4 years, I think in the last few months, it is the first time that investors are witnessing some bit of volatility, some nervousness. Of course, this has come with a lot of factors. Understandably, whenever markets get nervous, there are some factors behind why it is so. Therefore, and given that we are kicking off this new year, it seemed like a very appropriate time to take stock and probably listen from one of the most experienced fund managers that we've had in India, a person who, in my own personal engagement and understanding, very effortlessly straddles across asset classes, an expert in both equities and in fixed income, a splendid personality himself, and a great articulate person. Thank you so much for joining this call, Nilesh, and talking to us this afternoon. A very quick word about Nilesh. Nilesh is the managing director at Kotak Mahindra Asset Management Company for the last 10 years. Um, he, apart from playing an executive role there, he is a part-time member of the Prime Minister's Economic Advisory Council. He's on the board of the Association of Mutual Funds of India. He's part of a key committee at SEBI and is also the president of the Bombay Chamber of Commerce and Industry. Academically, he's a gold medalist, chartered accountant. And of course, as I said earlier, has kind of done extremely well insofar as money management is concerned. In fact, in all the profiles that he has been in the past across the few AMCs that he has led all the AMCs to be just the best fund house of the year whenever he was there. So it is indeed a pleasure to have you on this call, Nilesh, and listen to you. I personally look forward to hearing your thoughts. We will kick off with your initial thoughts, and I know you have slides which you're going to use to talk to us. So we'll kick that off with that, and after which I will probably kick off the conversation with some questions, and then we will take some audience questions after that. For those in the audience, there is a Q&A box, I believe, at the bottom of your screen. Kindly click on that and post your questions, and we will try and address as many as we can in this conversation. Thank you once again, everyone. Thank you, Nilesh, and handing it over to you to kick this conversation off.
Thank you, Shankar Bhai, for those kind words of introduction. If I quickly run through fundamentals of market and then the current positioning, hopefully it will give you good idea as to what's happening. If we look at Indian economy, we have moved from fiscal profligacy to prudence. We were spending far more money than what we were earning. Even today, we are spending more than what we are earning, but the amount is less. The banking system was riddled with NPAs. Today, we have one of the squeaky clean balance sheet. Inflation was double digit. Hindi film's villain was food black marketeer. Heroine was singing Mehngai Maar Gayi. Today, those villains and those songs have disappeared because inflation is mid-single digit. FX, it is down $50 billion, but $700 billion has become $650 billion. We don't have to pledge gold to raise FX loans at this point of time, or probably never ever in the future. Infrastructure, city infrastructure is bad. I work in BKC, and yet I'm making the statement that outside of city infrastructure is improving. Power cuts are becoming rare. Highways are good. Ports are as efficient as global ports. There is infrastructure availability. Mindset of Indians have become confident. Gone are the days where we believe whatever Agora said was right. From fragile 5, we have become fastest growing major economy. But we have a long way to go. We are still a poor country with $2,700 per capita GDP. At one point of time, our contribution to global growth was low single digit. Today, it is mid single digit. Tomorrow, it could be double digit. The world will be driven by three engines: US, China, and India going forward. Our challenge is uneven growth. 13 districts of India around metros like Mumbai, Delhi, Kolkata, Chennai, Bangalore, Hyderabad, Pune, Jaipur contributes half of India's GDP. Balance 692 districts contribute other half. For us, the challenge is while there is one India, it has three distinct subsets. One, 1% of Indians today live lifestyle of France. 27% live lifestyle of middle income country like Indonesia. And 72% of Indians live on sub-Saharan Africa lifestyle. Keeping that fundamentals in mind, the second quarter GDP number came at 5.4%, way below expectation. This was probably driven by rains, which were widespread this quarter, Shraddh period, inauspicious time where people stopped buying goods, and also government spending, which was in the reverse gear or lower gear because of election. This was reflected in cement growth, auto growth, power generation. Hopefully, this quarter, that is December, the growth number will improve because one, there is festival season like Diwali and Christmas. Second, all of you would have received many wedding invites. About 50 lakh weddings are happening, giving 6 lakh crore worth of spending to government, to economy. And hopefully government will accelerate capex to reach budget target. The jump is something which government should be able to manage. They spend in first 6 months about 4 lakh crore. They need to spend about 7 lakh crore in next 6 months. With this, GDP growth for December quarter should come upwards of 6%. If we are lucky, it could even come upwards of 6.5%. Our real challenge is that India is not doing enough to go to double-digit growth. Let me explain this. We are now having a coalition government. In coalition government, there are limitations in terms of what reforms can be done. Few things like Uniform Civil Code, Population Control Bill will be on the backstage. That's not going to impact growth much. Few things like infra investment, digitization, defense spending, spending on employment, skilling, housing to get votes, and the path of fiscal prudence under this coalition government is likely to happen. This will ensure that India remains fastest growing major economy in the world, but our growth rate will remain in mid-single digit, 5, 6, 7. Few things we will do, but we will do it in Indian style, 2 steps forward, 1 step backward. We will do asset monetization, but in small tranches. We will negotiate FTAs, but we won't take advantage of those FTAs. We will keep on improving ease of doing business, but on a step-by-step basis, not by a game-changer basis. Today, Indian entrepreneurs are burdened with compliance burden. I have an 81-year-old mother. If I don't maintain her health record, there's no crime, no law to punish me. But if in my canteen, if I don't maintain my cook's health record for 3 years, I could be put behind bar for 3 years. Who is more important to me, my canteen cook's health record or my mother's health record? There are such kind of laws which restrict Indian entrepreneurship. At last count, we needed to repeal about 26,000 such laws. So far, we have repealed about 600. That's how I say we are 2 steps forward, 1 step backward. There are many crucial reforms which we need to do to get out of middle income trap. Land reform, buying land is a nightmare. Labor reform, firing people becomes a nightmare. Farm reforms, agriculture is besieged with multiple constraints. Judicial reforms, Tariq pe Tariq does not create confidence. Strategic divestment like Air India. When government does divestment, people think they are selling family jewel. Well, Air India took 70,000 crore worth of fiscal funding to remain up in the sky. Today, Tatas have brought down their losses significantly. It made imminent sense to sell Air India when it was 100% monopoly in the sky, rather than after giving 70,000 crore to keep that elephant flying. GST rationalization, pension. I mean, every government employee wants old pension scheme, which gives them defined benefit. But the country cannot carry that burden of defined benefit. Now, government which fights election on old pension schemes are winning. The government which fights on new pension scheme is losing. Essentially, what we are doing is good enough for 4, 5, 6, 7% growth. What we are not doing, like land reform, labor reform, judicial reform, farm reform, strategic divestment, improving ease of doing by lock, stock, and barrel, those will take us to 10%, 12%, like China did it for 20 years. Now, your call is as good as mine. I doubt if we'll be able to do it. But one should never lose hope. Let's hope and pray that while what we are doing is good enough for 4, 5, 6, 7% growth, we also develop political will and societal will to ensure that we are able to do other reforms, and that will then push India's growth rate to 10, 12%. If we are able to do reforms, this is probably what India will look like. Today, China is almost reaching one half of global manufacturing. Half of the world's shoes are made in China. 75% of batteries are made in China. 90% of solar cells are made in China. They are able to do this dominantly because they have taken hard decisions. We, being a democracy, has a limitation in terms of how much hard decisions can be taken. Let's hope and pray India takes hard decisions when going is good rather than when going is bad. Now, converting that into market, if you look at equity market, everyone wants to know how much downside, how much upside. Let's first try to ensure how much is the downside. If you look at market cap to GDP ratio, our number is coming at about 137%. The historical average is about 84%. If market has to go back to historical average, Nifty should be around 18,000. We think that's extremely unlikely to happen. Why do we feel so? Well, look at the profit growth. For 10 years from 2010 to 2020, it grew anemically from 3 lakh crore to 4 lakh crore. Correspondingly, stock market returns were poor. Market cap went up from 62 lakh crores to 1 lakh 13,000 crore. But post-COVID, profit jumped from 4 lakh crore to 15 lakh crore. Correspondingly, market also moved 3 times from 113 lakh crore to 3 lakh 87 lakh crore. We believe this profit growth is here to stay, and hence average market cap to GDP ratio at 84% is unlikely. If you are waiting for investment during average market cap to GDP ratio or 18,000 Nifty, that's a low probability event. Second thing, many people are saying, when will FPI selling stop? Well, if you look at FPI, they have been buyer and seller continuously like a revolving door. CY22 they sold, 23 they bought. In this year, Jan they sold, Feb, March they bought. April, May they sold, June, July, August, September they bought. October, November they sold, December, they were neither buyer nor seller, very marginal difference. We believe FPIs themselves are kind of revolving door going up and down, and hence their importance in our market has come down. Today, against benchmark index weight of India at 19%, FPIs are underweight India at 16%. Domestic institutional and retail investors are much higher at 26%. Our market is driven by domestic investors, and at this underweight position, FPI will be reluctant seller rather than aggressive seller. In movie Lagan, we had seen local team outperforming Gora team. Same Lagan movie is happening in our market. Lagan was a one-day match. In our market, we are winning in all the three formats. In COVID period, there was one-day international. FPI sold in March, April, May, June, July, August. Retail kept on buying. Mutual funds kept on buying. Finally, FPIs got tired and joined the bandwagon. They came to play test match during October 21 to June 22. The net selling was 250,000 crore plus. Yet mutual funds, insurance companies, domestic investors kept on buying. And finally, foreigners came and joined the party. Then they came to play T20 match in India. On the election day, when they realized the seats are 240, they started selling aggressively and retailers kept on buying. This domestic participation gives confidence that downside of the market is limited. And look at from foreigners' point of view. Today, there are three big markets for them to invest: US, China, India. The Chinese market's EPS for last 10 years has grown 11% in renminbi terms. US market was up 94% in dollar terms. India market was up 166% in rupee terms. Undoubtedly, in India, growth was better compared to peer group. Now, let's look at in this market where we should take caution. The first caution is in low floating stock counters. There are counters where very limited public holding is there, less than 25%. In those kind of counters, it is possible that valuations will remain high. Undoubtedly, those stocks have corrected during this correction, but we still believe it is time to stay away or being cautious in this low floating stock counters. The most important thing is moderating return expectation. Last 5 years, every 3 out of 5 stocks in BSE 500 went up more than 100%. 3 out of 5 doubled in last 5 years. A lot of it was profit growth, but some of it was also PE ratio expansion. Today, almost 2 out of 5 stocks in BSE 500 are trading at more than 50 PE. 4 companies are trading, discounting what will happen in 3024, 1,000 years ahead. This higher valuation does give discomfort to us. This is the most important slide of the presentation. Last 5 years, market return was about 18%, driven mainly by small and mid cap at 27%. Before that, 15 years market delivered just about 11% return, largely driven by large and mid cap. And when you take average of 20 years, broad return was about 13%. And the difference between large, mid and small was almost very, very narrow. We believe if you are investing with this expectation, last 5 years small and mid cap return, you will be disappointed. The actual returns will be somewhere between these two numbers. You need to invest, but with very, very moderated return expectation. This is the time to buy quality over momentum. High floating stock market discovered prices over low floating stock, and reasonable valuation over expensive valuation. In fixed income, we think it is time to go for duration, as interest rates will be cut over a period of time. We don't expect rate cuts to begin in first half of CY25, but July 2025 onwards, there will be rate cuts in US, in Indian market, followed by what would have happened in US market, and that will benefit long duration paper. Gold, we have remained bullish for some time, as central banks around the world are buying gold like Indian housewives. Their purchase is about 1,000 tons every year for last 2 years. And this year also they are on the run rate to achieve 1,000 tons of buying. Like Indian housewives, once they buy gold, they don't sell. This creates pressure on gold prices as there is limited supply and higher demand. This trend is likely to sustain for some time, as countries like China and India has allocated far less money to gold compared to countries like US, Germany, France, Italy, Netherlands, and so on and so forth. Gold prices also benefit when US interest rates come down. Some of it might be reflected in gold prices today, but a lot of it is likely to reflect going forward. If I have to summarize, global growth will slow down. There will be avalanche of rate cuts in second half. In debt, long duration, longest maturity should outperform over next 12 to 18 months. Gold should shine over medium term. Equity returns, one will have to moderate return expectations significantly. There is better risk-return trade-off in large caps. FMCG, which are focused on rural India. IT companies which are leveraging artificial intelligence. Private banks which are not overexposed to unsecured lending and microfinance institutions. And telecom should outperform the market. Chemical at some point of time can provide entry point. Where you need to be cautious is low floating stock counters, especially in micro caps and small caps. This is how we foresee future over next 12 to 18 months, but happy to take your questions.
Thanks for that, Nilesh, in terms of nicely summarizing, where we are. Um, if I may, I just one housekeeping announcement. If the audience wants to, please post your questions on the Q&A box. But I'm going to kick that off with a few things that are on top of my mind, Nilesh. Um, this thing about how in the last 4 5 years, our growth, whether it's at a GDP level or if you were to look at the corporate profit growth, the sense that one gets is a driver of that, an important driver of that was the government's capex spending, and how that kind of drove up overall growth. The other element was that somewhere during COVID, there was a sense that there is a certain amount of savings that people had built up, and there was therefore a consumption, move up that happened. Eventually, that translated into some bit of wealth effect in terms of consumption. Now, if you just look at the last few months and the data points that one is seeing some signs of moderation in both of these. And you alluded to the government capex spending yourself, but one is seeing both of these kind of show some bit of nervousness. What are you kind of picking up over here going forward into FY26, both on the consumption side, the government capex side, and also on the private sector capex side?
So, Shankar, you have hit the root cause of problem. Let's talk about private capex. We all know it is on the back foot, and there are multiple reasons behind it. One, if father is iron and steel producer going into factory and you know rolling up sleeves and doing work, the son or a daughter may not be interested in pursuing the same business. They want to be professional, they want to be in financial market, they don't want to get their hands dirty in the on the ground. Second, there are many businessmen whose kids have gone abroad and they don't want to return to India. Third, there are many businessmen who are running their business well but are worried about technological disruption. The steel guy is not sure what green steel means, what carbon tax means. They want to wait. There are businessmen who are burdened, and this is majority, with ease of doing business. I give you small example. The wage slips font and color is prescribed under law. The swing of the door is prescribed under law. Your door should open in particular manner. If not, then you can go to jail. Now, this kind of compliance burden restricts our entrepreneurs. On top of it, you have worry from dumping from China, the competitiveness of China.
Really, the swing of the door?
Yes,
Yeah.
yes, it is prescribed under law.
Wow.
So
Sorry, please.
we are looking at multiple things which has resulted into slowdown of private capex. And it will take bold reforms which will unleash private capex. Ambani, Adani, Tata, Birla, Jindal, they will continue their capex. But we also need small and medium enterprises to do their capex. And that is where we are seeing a slowdown, a subduedness. Financial market reform, real market reforms can take this capex to higher level. Now, whether this will happen or not, I'm 100% confident that if we are pushed to the wall, we will do it. But we need to do it when going is good rather than wait for bedtime to do it. And right now, the time is good. In terms of government capex, I think I have no doubt in my mind that government will achieve budgeted target. Last year, election was there in May, and Feb and March were impacted. But despite that, out of 10 lakh crore target, they could spend 9 lakh 50,000 crore. This year target is 11 lakh 11,111 crore. April, May, June, July did went in election and formation of government. But August onwards, the pace has picked up. Government is getting revenue. They have ability to raise money through divestment. And that's good enough for them to generate enough resources for capex. The third part is consumption. Now, here there is a challenge. When urban consumption does well, rural doesn't do well. When rural does well, urban doesn't do well. As of today, we are at a stage where bumper kharif crop and rabi crop has pushed rural consumption higher. It is reflected in tractor sales, it is reflected in two-wheeler sales, which are primary rural market driven. It is reflected in consumer staples commentary that rural India seems to be doing well. But in the urban India, there is slowdown. Shankar bhai, in our generation, we would never borrow to travel. But the next generation is borrowing to spend, travel, buying mobile phone. Now, when the going was good, you spent money, but now you have to pay EMI, and that's hitting consumption. If you buy 1,50,000 rupee of mobile phone, the benefit to Indian economy is 1 or 2% because money goes abroad. And then you have to cut expenditure on toilet, on soaps, on detergents. all kinds of things. So our consumption pattern is shifting, and a lot of spending which we are doing, like foreign travel, like foreign education, like mobile phones, like electronics, they are sending money abroad rather than keeping it in India. And which is why consumption is slowing down. When we go and buy a Gucci bag or a brand, I mean, the benefit is to the global economy, not to us. So all those things have come together to make capex, consumption, and government capex a very, very confusing figure. I think we will do well at 4, 5, 6, 7% GDP growth because few things we are doing right. If urban consumption is slowing down, rural will pick up. If rural is slowing down, urban will pick up. And there will be equilibrium between consumption, government spending, and private capex. If we do the reforms, land reform, labor reform, farm reform, judicial reform, strategic divestment, ease of doing business, then all the cylinders will fire at the same time. Your call is as good as mine whether that will happen or not.
But I heard you say when you spoke earlier that the timing, it is a good time now. So given that in less than 3 weeks we have the big event coming up, the annual big event that's coming up, and the fact that we have a politically kind of a light calendar, and they still have a 3 year kind of a runway. Are you expecting something from the budget in terms of some of these, if not all, at least one or few of them, which are probably relatively easier to do, the big reforms that will take us from, say, 6% to, say, 7, 7.5%?
Uh, Shankar, by big reform is taking us from 6, 6.5 to 10. Big reform is taking us, instead of growing 1 year at 8%, 20 years at 8%. I doubt if we have ability to do that kind of reforms when going is good. We'll pledge gold when we need to borrow money and no one else is giving. But we won't stop import of gold and sending money abroad when there are high FX reserves. Being a democracy, being a coalition government, there is limitation on what government can do. There's limitation on how they can end Inspector Raj. The government employees will require a discipline. They will require, like, in UP, for example, the government wanted mandatory electronic attendance for teachers. You know the reason why they demanded it. But teachers protested and finally government gave up. The reason is that the teaching community is fairly large, vocal. You can't afford to offend them. So there are multiple challenges in democracy, and which is why my feeling is that budget will be good, undoubtedly. The path of fiscal prudence will be maintained, capex spending will be there. But these are all good enough for 4, 5, 6, 7% growth. And mind you, 5, 6, 7% growth will make you fastest growing major economy in the world. But we can't become like China with this kind of reforms. Those will require tough decisions, which a coalition government will find it very, very difficult to do it.
On that point, Nilesh, I think what we are seeing in the last few quarters is with some of these state governments, elections happening, you're seeing this, the spending that's, in the form of social spending, the Ladki Bahin scheme, or, some of this. And various economists are saying that roughly about 2 to 3 lakh crores is what is the kind of money that will go there. Are you therefore sensing that somewhere, after having done the huge legwork of, the capex spending, we are shifting gears into kind of saying from capex we go into revenue spending? Is that a pattern that can happen? Therefore, consumption stories and all of those from the investment cycle that we saw.
So, Shankar, by the government is not short of resources. If they do divestment, they'll be able to fund all Ladli Behna scheme and yet will have enough money to do capex. If they monetize their giant asset base, they'll have enough money to spend on capex as well as provide for Ladli Behna. If they tighten their belt, and we are seeing examples of US government where they are spending and what they are spending. I'm sure our government will also can also learn from them. So it's not the question of resources between divestment, asset monetization, and improving tax compliance. There is enough resources available for populist measures as well as for capex and investment. And what we need from government, in one simple word, is end of Inspector Raj. Let Indian entrepreneurs be free. They don't have to worry about compliance burden. That itself will create double-digit growth.
Okay. Now I'm going to just turn to the Q&A box. Just give me a second. I'm seeing some questions roll in. I think one of the questions that has come is on real estate. Now, again, just tying that question, that the question is on what is the view on real estate. Also tying this back to this whole, capex spending from private sector, or rather the household capex, which is really the real estate sector. How are you seeing that actually play out? Because that can be an important driver for the economy. I think the view is on the sector, but I'm just asking and extending that question to the larger issue that is there.
So at one point of time, real estate contributed 15-16% of our GDP. Then, thanks to multiple things, it came down to about 7-8%. Now it is back to low double digit. Undoubtedly, real estate could be one big driver for India's economic growth. However, it requires, like any industry, openness and transparency. Today, when you invest in mutual fund, there is SEBI to protect you. There is a method in which I have to manage money. If I do something wrong, I could be punished and thrown out of my job. Now, Shankar bhai, aap dekhiye, the guy advertises for the building with photoshopping. Where there is nala, they show river. Where there is dumping yard, they show garden. And they get away. Very rarely builders deliver on time. Very rarely they deliver on budget. Very rarely you can understand what the agreement is. And despite that, real estate industry is doing well. Real estate industry can do even better if they improve governance and transparency. Now, there are few names, corporate names, which are doing that. When you buy from Godrej, you know you will get quality. When you buy from Raheja, you know you will get quality. And so, like DLF, Prestige, and so on and so forth. I think if you buy real estate from reputed developers of quality construction, you will be able to make return in it. The returns will be lower than stock market, but you will still make some money. But if you are stuck on some bad location with a bad builder, chances of you getting even your capital back is very, very limited. So real estate is all about choosing the right location and choosing the right product. In the same lane in Mumbai suburb Kandivali, one property goes at 35,000 per square feet because it is gated community. And outside of that, one thing goes at 15,000 because it is simple building, slightly dilapidated. 15,000 versus 35,000 on the same locality. So real estate is all about location, 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 and the product, product, product. Choose the right builder, choose the right product, choose the right location, you will make money.
But as a sector, as an equity sector, what's your view?
Be with quality guys.
Okay.
Shankar bhai, very rarely you will find an industry where consumer is borrowing at a cheaper rate than the manufacturer. If you go to buy a car on loan, your rates will be 10, 11, 12%. If Maruti goes to borrow for making cars, their rates will be 7, 8%. In housing, it is ulta. Builder borrows at 12, 14, 15%, and you, housing loan, borrows at 7 and 8%. Obviously, it shows that people don't trust builder. You have to invest with person whom you can trust. So real estate sector will do well provided you are with people whom you can trust. And that straightway narrows down, the number of companies in which you can invest.
Right. Okay. Just extending that point on real estate, one of the themes that has kind of emerged in the last few years is REITs. And also, as an extension to that, I think InvITs is the other one where, income earning assets, somewhere the government is also monetizing its assets. How are you seeing REITs, InvITs as a complex in terms of income earning with some potential capital gains? Is it a good hybrid for investors to look at over a period of time?
I will strongly recommend investors to consider REIT InvIT as part of their portfolio for diversification and for exposure to real estate. Shankar bhai, if you have a property, भाड़े पे चढ़ाना, रेंट टाइम पे भरना, टैक्स भरना, वो जिसने भाड़े पे लिया उसके साथ डील करना, that's beyond us. All of us will find it very, very difficult to keep pace with that. REIT InvIT does that on a professional basis, and return will be almost similar. Of course, you get a lottery on a location or a product or a builder, you will do very well. But I'm talking about larger portfolios. So instead of going physically into real estate, my recommendation will be build REIT InvIT as part of your portfolio. You will do well there.
Okay. There are a few questions on the currency. How do you see the currency? And a related question is on China's economy. And I'm sure people are wanting to know about, what happens to the yuan and, what happens to the Indian currency. I'm going to request you to, while you are talking about this, also probably weave in your thoughts on how do you see these global, very important kind of developments like the US Fed policy rate and the dollar and this whole how is that going to play out and how can it impact us in the year ahead?
So in the US, on 20th Jan, President Trump will start. And Shankar bhai, hand on heart, would we have ever predicted that the guy will say, Canada mera, Greenland mera, Panama mera? He is too unpredictable for us to expect or predict what he will do. But based on utterances, America first policy will be clear. Second, they will levy tariffs, they will cut government spending, and they will try to forge relationships which is win-win for US as well as the other party. Ideally, they would love win for US and loss for others, but because that's not going to happen continuously, regularly, they will create win-win situation rather than loss-win situation. Fed has done an exceptionally good job, but with Trump, they are also uncertain. In fact, the starting point was Jeremy Powell saying that I will not resign even if President Trump asks me to do. Then President Trump said, I have no intention of firing him. He can continue till his term. So it just shows that relationship is not as warm as between RBI governor and government of India. Fed will be data driven. They will be scratching their head to figure out what Trump is going to do. And hence, to some extent, US policy will become unpredictable. China, on the other hand, is a juggernaut. Their debt is now higher than US and European Union, but their leadership in critical technology is amazing. They are able to do many things which other countries will find it difficult to do. For example, humanoids, artificial lungs and those kind of things, chemical warfare. I mean, they are doing many things which other countries will find it difficult to do. But nevertheless, that has given China a humongous advantage in terms of technology, in terms of scale and efficiency. And China as an economy will continue to do well. But there are underbellies for China also. For example, how did an economy which grew many times in last 10 years had EPS growth of just about 1% a year because there was no capital allocation efficiency. Government was happy to provide capital, market was forced to provide capital, and hence growth came entirely from equity capital rather than efficiency. And which is why you have seen muted earnings growth in China. Overall, I will say China will remain enigma. Their technological leadership is humongous, but their political leadership and economical leadership could have challenges.
Is it
US
is it an
will
investable
continue to do
market?
well.
Is it an investable market, Nilesh bhai? China or
Shankar bhai, we don't know enough to make a statement. I mean, when I looked at earnings growth, I was surprised. No wonder for 17 years, Chinese market hasn't delivered return because EPS growth is paltry. So I will say it's far better to invest in US because you will have confidence to average. China is a momentum play. You invest with a view that in case there is a loss, you can bear that loss.
okay? And on the currency, therefore, a dollar, rupee, CNY. I'm not saying that people are, it's not about actually forming a view on CNY, but the point is, there is a fear that they will suddenly depreciate or they'll devalue given what's happening now, and therefore it will impact us. So just to kind of put things together over there.
So 1 rupee is linked more to Chinese yuan than dollar. Second, RBI has $650 billion to defend to defend rupee against speculators. RBI is not going to use those reserves just to support a line in the sand. They will allow rupee to find its own level. The destiny of rupee is to depreciate by the productivity differential and inflation differential of India versus its trade partner, which means we should be depreciating between 2 to 3% every year. This depreciation can happen all of a sudden also, or in a calibrated manner. But in your calculation, do build in 2 to 3% depreciation of rupee every year.
Okay. Okay. While you said that, what Trump will do is unpredictable and quite understandably so, people say that in this whole US versus China thing and all of that, India could benefit because our equations with them are good and whatever for various other reasons as well. So do you see that as a tailwind for us? And are there any areas where we can actually tangibly benefit?
So undoubtedly, Shankar bhai, we have an opportunity, we have a window. When our IT guys developed Y2K solution for American firms, they were desperate and they needed someone to do the job. It was a dirty job, but we did it. Imagine if this work was outsourced to China. One, because they were not proficient in English, they would not have done the job. And second, if they would have done the job, they would have put some bug into it, some virus into it. Indians have written billions of dollars of programming for Western world. And not even once Western world had to worry about virus bugs, which they have to constantly worry when buying some things from China. Collaboration with Indian IT industry created win-win situation for Western world. Their cost came down, efficiency went up, their national interest was not compromised. It was a win-win formula. Same thing happened in generic medicine. We provide almost half of America's medical imports at a price which is less than 10% of the total medical spend. Now, we have to extend this into other sectors. India-US relationship can create win-win situation compared to lose-win situation today US is having with China. But we'll have to make a case for it. बचपन में शंकर भाई कहानी सुनी थी, एक बिल्ली था, दो बंदर था। वो बिल्ली बड़ी सयानी थी तो दोनों बंदर की रोटी खा गई। We have to become like that cat. On one side is US, Europe. On other side is China, Russia. We need to play both of them so that हमें रोटी मिले, कोई हमारी रोटी ना खा जाए।
Right. Right. Okay. Now on asset classes, there is a couple of questions here. I think people are saying that gold, you were clearly positive. You were saying, it's something that you should have an exposure to. There's a question, what about silver? Is there an angle there because solar panels and industrial complex? So is there a view there? And also on crypto, how can we miss it?
So silver, what central bank buying is for gold. Silver is supported by industrial demand, industrial consumption, and electronic silver will play an important role. And we believe directionally both gold and silver should do well. It's quite likely that silver may do well little early compared to gold. Gold will depend upon central bank buying. They are institutions, they will buy when they feel price is right. They don't have to fill a quota of buying like an industry. So we believe silver is likely to outperform gold in the near term, but eventually both needs to be part of your portfolio. On crypto, my knowledge is very, very limited. I think it's not an investment, it is high risk, high return gamble. One should do it if they are comfortable.
Okay. Okay. Okay, now coming back to India and the conventional asset classes, which is where most of our monies are invested. On fixed income, you mentioned that you were a little positive on duration as a strategy. And somewhere there is this thing about the RBI rate cut cycle where it will go depending upon what the Fed is doing, so on and so forth. So, how are you seeing that actually pan out in the next year or so? And therefore, from a fixed income investor's point of view, what should one kind of be doing?
So, Shankar bhai, if you are comfortable on credit risk, then performing credit is a good option for fixed income investors. If you are looking debt kind of safety, then returns will be lower. If you're looking at equity kind of risks, return could be higher. Now, many people invest in debt not for return but for safety. Then performing credit is not appropriate. One can look to invest in duration of high quality bonds, which will give you higher return than coupon when rates are falling and lower return than coupon when rates are rising, which is where a dynamic bond fund will be more appropriate for you. Those kind of bond funds manage duration dynamically, don't take a lot of credit risk, and hence it is a safe option for investors. My recommendation to investors will be consider even hybrid fund as part of your debt portfolio. There are hybrid funds like equity saving schemes, balance advantage fund, which will be appropriate for the debt investors.
Okay, now the question that everyone wants to kind of get an answer for, so specifically me, what is the chance that this year, okay, is FY26 or CY25, that returns from equity is very close to fixed income returns? Where do you see this? Are you going to see substantial outperformance of equity like we have done in the past? Are you seeing a convergence? What is the expectation of the relative asset class?
So, Shankar bhai, the gap between large, mid, small will narrow. Between debt, equity, gold will narrow. But लंबी रेस का घोड़ा तो अभी भी equity है. It will deliver real return. It will deliver more return than fixed income and probably gold also. If you want to generate equity kind of return in debt, then you will have to take credit risk. And all credit risks need not come right. Some can go wrong. And hence, I will again say, lambi race ka ghoda is equity. Debt will face its own challenges and will underperform equity from a return point of view.
But for this year,
This year, the gap will be very, very small. The debt, gold, and equity returns all will be nearer to each other.
okay. Okay. Now on equities, you said that large cap is what you prefer, and there is always this concern about valuations in mid and small caps. Is there some kind of a ticking time bomb over there? In the last 3 4 months, since the market started getting nervous, large caps have actually underperformed, and mid caps have continued to be where they are. So, is there a likelihood that mid and small caps can therefore kind of see that kind of a nervousness in the next few months? Is there some bubble building up over there? I mean, what's your sense on that space? Because it's gone vertically since 2020.
The bubble is building up in many low floating stock counters with a small cap, mid cap, or large cap.
Hmm.
Shankar bhai, if you can control the float, you can put whatever price you want. And today's world is hyper connected on social media. You just have to find financial influencers. You just need one buy to buy into your stock. You just need, those kind of things. So my feeling is that it's not small, mid, large. It is whether the prices are discovered through market or not. Because it is listed on market doesn't mean the prices are discovered through market forces.
Hmm.
Floating stock, influencers, all those factors one will have to keep in mind. And finally, the operator runs the counter for himself, not for you. So it's quite likely that the price will be paid by innocent traders or investors who will be holding on to the baby.
Hmm. Speaking of that, this has largely happened because of the fact that you've seen retail investors get into the market in a very big way, right? A lot of individual investors getting into the market directly, DIY investing, F&O speculation. So there is a lot of demand-led kind of money coming into the market, probably looking at returns. And today we saw the numbers from the mutual fund, for December. And again, you're saying, SIP flows being all-time record, your equity flows have been quite good. How are you reading that part of the equation, which is the money flow that is there in the market? What's your experience? I mean, it's a little touch and feel in terms of commenting on that, but how are you kind of expecting that to pan out over the year, especially in a year when returns from equity is going to be a little tough to make? Are you sensing that is a structural move? Because there are people who have spoken about that, right? Our equity investments are very low, and therefore structurally we can go up, but along the way we can have bumps. So, how are you reading this whole retail flow into the market in the very near term? I'm saying the next 1 year kinds.
So my head tells me that investors have matured. Work done by advisors, distributors like yourself and Centrum have improved their knowledge. They know that there will be ups and downs, and a falling market and a cheaper market is not the best time to sell. It is the best time to buy. By and large, this will hold. If you look at media today, they behave very, very responsibly in financial market. I haven't yet seen an anchor who is pushing kachra stock or who is saying in COVID ke bech do because market girne wala hai. They have by and large given same advice which a sane fund manager or a sane distributor will give. Second, investors' own experience over last 20 years, 30 years does give them guidance. Work done by yourself and advisor community is again similar. And we fund manager also pass the same message. And finally, the proof of cake is in eating it. One of my ex-colleague met me at a business standard event and said, Nilesh, why are you launching funds at this point of time? You are making the same mistake which you made in 2000 when you had launched technology fund and collected a lot of money, and then people paid the price. I said, fair enough. Will you short the market for 10 years? He said, no, 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 no. I said, will you short the market for 5 years? He was unwilling to do. Will you short the market for 3 years? He was unwilling to do. So I said, भाई तेरे को 3 साल के लिए मार्केट महंगा नहीं लगता, and I am taking 10-year money from my investors. So why should I not take money? There will be ups and downs, which I am telling my investors. I am asking them to moderate return expectation. I am asking them to invest on a longer term basis. I am asking them to follow asset allocation. Where is comparison to 2000 when market was trading, when IT stocks were trading at 100p? Today, there are some defense stocks which may trade at 100p, but we are not investor over there. So things have changed, people have matured, and that is why my feeling is that every correction we will see more flows coming into our market.
Okay. Okay. Lastly, on equity earnings growth per se, after the superlative growth that we have seen, next 3, 4 years or next couple of years also, how are you seeing earnings growth actually pan out? I mean, from an EPS broadly, where are you seeing those growth numbers settle down?
So 4 lakh crore became 15 lakh crore between FY20 to FY24.
Hmm.
Can 15 lakh crore become 60 lakh crore? Answer is clearly no.
No.
That kind of 4 times growth is not going to happen in next 5 years for sure.
Hmm.
Now, if we see today, our profit to GDP ratio is roughly about 5.56%. For ease of calculation, let's take it at 6%. Now, if my GDP grows roughly at about 6-7% real, 4% inflation, that's about 10% growth. If GDP is growing at 10-12%, automatically 5.5 to 6% of that will be reflected into corporate India's balance sheet. So my feeling is that we are looking at high single digit, low double digit earnings growth for companies in line with our nominal GDP growth. And hopefully that will come through. Will there be periods like September 25, September 24 quarter? Yes. But in case our disappointment is deferment of earnings by 1 or 2 quarters, not cancellation of earnings like in many other markets.
Okay. So putting all of this together, in a nutshell, when a customer is investing right now, and you gave us a lot of idea to chew on, saying that gold is good, silver, REITs, InvITs, global equities a little bit, then of course our own local asset classes. So if one were to have, and typically people have a strategic asset allocation, saying that over a period of time, this is how much I want to be in equity and debt. And then there is a tactical tweak that you make as you go, depending upon the shorter term consideration, which is more like a 6 month, 1 year kind of a consideration. If within that strategic asset allocation today, where would you say the tactical tilt should be today? Should we be a little bit underweight on equity, overweight on equity, underweight on debt? If you could just give us that, but that would be a great way to conclude probably a conversation which can help people stitch their portfolios together.
So my recommendation will be neutral weight equity. It's a fair value market, not very cheap, not very expensive. But within that, go for quality, high float, and reasonable valuation. Little bit overweight large cap, little bit underweight small cap and mid cap. In duration, equal weight, but go overweight long duration. Gold, silver, overweight, but with a medium-term horizon. REIT InvIT, overweight. There are some excellent opportunities available. In fact, एक का IPO कुछ दिन में आएगा. So those are the overweight. Most important is moderate return expectation and be a long-term investor.
Super great. Thanks so much, Nilesh. Thanks so much for taking time out for this. Last, any message for investors? Anything that you want to kind of say to investors that can help them in the journey? Any book or anything, any thought that comes to your mind?
Just learn from your own experiences and make mistakes which you can afford. That's
Oh,
good enough.
absolutely. Make mistakes only that you can afford. Great, wonderful. Thank you so much,
Thank
Nilesh.
you.
So much. Pleasure having you. Thank you so much. Thank you. Bye
Bye.
bye. Thanks so much, everyone. Hope you enjoyed this conversation as much as I did. Thank you and have a wonderful day ahead. Thank you. Bye bye.